All right, let's dive in. This week, we're taking a look inside the latest from Barron's, and honestly, it feels like the financial world is following a script we've all seen before. You know the one. It's got conflict, corporate giants, and of course, some hidden dangers. So let's get the show on the road. And Barron's really sets the stage with this headline. The market's seen this movie before. It's not an Oscar winner, they say. And that just hits you, right? It's that feeling of familiarity, but not in a good way. It's like, we know this story, and we kind of know it doesn't have the happiest of endings for investors. So what exactly is playing this week? Let's break down the acts in this whole drama. We've got the big geopolitical main feature, and then some really juicy corporate subplots. All right, kicking things off with the main feature. Barron's is calling it a barrel after another, and it's exactly what it sounds like. A classic story, really. An old conflict that's suddenly back in the headlines, all about oil prices, and, you guessed it, rising tensions on the world stage. So what's going on here? Well, the main players are the US and Iran. The US reportedly bombed a key export hub for Iran, and Iran hit back, striking ports over in the UAE. And these aren't just any ports. We're talking about critical shipping routes. An attack there, well, it sends these shockwaves of uncertainty all over the globe. It's a huge mess for supply chains. And of course, there's an immediate impact for investors, for us. Check this out. US stocks are already down 3.6% since these attacks started last month. That's a pretty clear signal that the market is, well, it's nervous. And no surprise here, this whole conflict is hitting energy costs directly. I mean, at one point last week, the price for Brent crude shot up, briefly touching that $120 a barrel mark. Ouch. So here's the big takeaway from this part of the story. This movie is far from over. I mean, the reporting makes it pretty clear this conflict is nowhere near a resolution. That means oil is likely going to stay expensive, and that dreaded word, stagflation, that awful mix of slow growth and high inflation, that risk is probably going to hang around right into the summer. Okay, so that's the main storyline. But like any good movie, you've got these fascinating subplots going on. And this week, they feature two absolute giants, two very different companies, but both incredibly powerful, Nvidia and Berkshire Hathaway. So let's start with Nvidia. There's this massive shift happening in the whole AI world. For a while, it was all about training, the super expensive part where you build these huge AI models. But now, the focus is moving to inference. And that's just a fancy word for putting those models to work, actually having them do stuff and create value. And here's what's so interesting about this. When you're in the training phase, cost is, well, it's not the top priority. You just want to build the best model. But when you get to inference, where the real ongoing money is, suddenly cost is everything. And this is exactly where Nvidia is pivoting. They're even licensing tech from a smaller company, Grok, so they can build custom chips for this new world where every penny counts. And if they get this right, the payoff is just wow. We're talking a projected 85% jump in free cash flow for Nvidia this year alone. And there's always a but, right? The big question on every investor's mind is, how long can this last? How long can these big tech companies keep spending money at this insane rate? Okay, so let's shift gears to our other subplot. While Nvidia is out there navigating the wild future of AI, you've got Warren Buffett's Berkshire Hathaway, and they're flexing their massive financial power in a much more, let's call it, traditional way. Get this, on one single day, March 4th, Berkshire bought back $225 million of its own stock. Just boom, in one day. That's about as powerful a signal as you can get, basically them screaming that they think their own stock is a great deal. And just to put that number into perspective, if they kept up that pace every single day, they could buy back over $50 billion of their own stock in a year. That's just a wild amount of money. So you might be asking, how is that even possible? Well, it's pretty simple, actually. They're sitting on a mountain of cash, $373 billion of it. A number like that gives you unbelievable firepower to do whatever you want. Buy back shares, snap up other companies, or just ride out pretty much any economic storm you can imagine. All right, let's leave the corporate world for a minute. The next scene in our script takes us to Washington, D.C., where, as always, there's plenty of drama. Two different stories, but both are a really big deal. So, up on Capitol Hill, you've got a couple of cliffhangers. First, there's a bunch of uncertainty around the future of the Fed chair, tied to some investigation. And at the same time, you've got this partial government shutdown that's just causing chaos at airports. We're seeing airline CEOs practically begging Congress to fix it because you've got hundreds of TSA agents quitting and air traffic controllers working without pay. It's a mess. And for our final act, we're going to look beyond the obvious headlines because Barron's is pointing to something lurking in the shadows, a potential risk to the whole system that might just be more dangerous than the stuff we see on the front page every day. Let's talk about something called private credit. It's this massive $3 trillion market. Basically, you have these big investment funds loaning money directly to smaller companies, and it's all happening with way less oversight than a normal bank loan. Now, here's the problem. A lot of that money went to old-school tech and software companies. And with AI moving at lightning speed, well, the business models of those companies could become obsolete, like overnight. And if that happens, all those loans are suddenly at risk. And this right here, this is what should get everyone's attention. Barron's makes a really chilling comparison to the 2008 financial crisis. See, this private credit market has the exact same fatal flaw that the mortgage bond market had back then, a total lack of transparency. What that means is if these loans start to go sour, nobody, not even the regulators, really knows who's holding the bag. Nobody knows where the risk is or how fast it could tear through the entire financial system. It's basically a multi-trillion-dollar blind spot. And we'll end on this really sobering thought from a researcher. It's a powerful reminder, isn't it? Investors who lost money in 2008 didn't lose it because they panicked too early. They lost it because they paid attention too late. The biggest risks aren't always the ones in the big, splashy headlines. Sometimes the real danger is the quiet story you're not paying attention to. So the question for all of us is, are we watching the right movie?